Welcome to the Modern Real Estate Investor Podcast, where we interview the biggest and most successful real estate entrepreneurs, investors, and capital raisers in the world to provide you with the tool sets, the mindsets, and the skill sets to help you conquer yourself, your life, your marriage, and use real estate as your wealth creation vehicle so that you can live a more successful, happy, and fulfilled life of growth and contribution. If what you're after is having it all, if what you desire is becoming the best version you can be across all areas, mentally, physically, emotionally, spiritually, sentimentally, and financially, you've come to the right place. We will bring to you the best of the best real estate entrepreneurs who will give you the insights, knowledge, experience, and skills so that you can go out and crush it financially and across all areas of your life. Grab pencil and paper, sit back, enjoy, and you are welcome to the Modern Real Estate Investor Podcast. Hello, Modern Kings and Queens. Welcome to another episode of the Modern Real Estate Investor Podcast, where we interview some of the best, most experienced, knowledgeable, skilled real estate investors in the world to provide you with all the tool sets, the mindsets, and the skill sets for you to conquer yourself, your life, your marriage, and use real estate as your wealth creation vehicle so that you can live a more successful, happy, and fulfilled life of growth and contribution. So today I have with me Larry Pendleton. He's a real estate investor, CPA, and tax strategist on a mission to help people, and exclusively and more focused on real estate investors achieve financial abundance through real estate investing and taxing strategy. So we have an incredible speaker today. Super excited to dive into the topic of like finances and taxes, which is something like that I'm not super knowledgeable about because I wasn't taught about it for my entire 22 years of life. So it's crazy, right? But I'm glad that I have here today an expert who's going to teach me and more importantly, who's going to teach you about some taxing strategies that you could use to achieve financial freedom, save money, and keep more money, right? So, Larry, thank you very much for being here, man. I really appreciate you, and you're welcome to the show.
I appreciate you having me, Alex. I'm looking forward to adding value where I can.
Great, man. So, the first thing that I do with my guests, Larry, is I ask them to walk us through their real estate investing or entrepreneurial journey in 75 seconds or less. You can go ahead and get started whenever you want.
So I've been a tax strategist CPA for over a decade now. So really started PC Financial Services, our tax business back in 2016. My partner at the time was already in real estate at the time. I always knew the tax benefits of investing in real estate properly in order to save on taxes. And so roughly around that was 2013, so 2017, I actually acquired my first property with his help, kind of to your point, is having the right network in place and connecting with the right people to kind of take that property and then spin that off into, okay, there's actually more here. I don't have to keep just doing one property at a time, do bigger deals, and start going to different networking events, meeting others, and then just leveraging my skill set to join some syndications and build up my portfolio as well. And we continue to do so today with various partnerships that we have in place.
Great, man. So you made yourself part of some syndications. So what was the value that you brought to the table when in terms of becoming a partner in a syndication with other operators as well? What was the value? Was it like on the financial side of analysis and underwriting and all of that, or was it something else?
Yeah, more the underwriting, the financial side, and then especially when you have a whole bunch of different limited partners, passive investors involved, kind of having a point person to kind of point them to like, hey, this person can kind of help on that side of things as well. So adding value to not only the GP group as a whole, but also as to the LPs as well, and breaking down the finances and making sure all the numbers are straight and what they can actually qualify for tax deductions.
Cool. So man, let's focus on those two things for today. On the like underwriting side and analysis, right? That you specialize on or in, and then all the taxing stuff that that you may want to talk about and bless us with. So when it comes to like underwriting, man, what do you look for in a deal, right? Like what do you look in your underwriting model? What are some key points that jump out, or what are some things that you look for to decide whether or not a deal is a good deal?
Yeah, I mean, we try to do our quick rule of thumb aspect of it, and all depends on the area. I mean, as of August 2023, the market's kind of all over the place depending where you go. Because at a point, like, we didn't do anything above $100,000 per door. It just didn't really make sense at that point. And you get into the 1% rule or 2% rule, or however people want to break that down, determine, okay, is there enough cash flow coming in, or the rent's high enough, market rent's high enough to justify this purchase price for the property itself? Because you hear the term of, you review 100 deals, you may put an offer on 10, and one may get accepted from there. So in order to kind of crank through all those different deals, you gotta have a quick rule of thumb, and then you just kind of dive in further. Okay, like, what is our tax? What's our taxes going to be? Our real estate taxes? What the insurance is going to be? Kind of connect with different insurance brokers on stuff like that. What's our property management fee if we're not going to have it in-house associated with it there? And then where is the value add? Okay, what is the cost of material to get this property turned, with the cost of labor, stuff like that as well. So, and there's other aspects to it, but you're starting to compile stuff once you kind of gone through that first, like, hey, this is our high level, like, yes or no. Okay, now we've got the yeses. Let's go into a deeper dive with these.
Okay, got it. So, man, when you say your rule of thumb, obviously you have a rule of thumb because you're going through like so many deals every single day. 100 deals to be able to make an offer to 10, and then maybe one of them gets accepted. So you gotta sort through a bunch of deals to be able to get to, a few good deals to be able to get to making offers and eventually landing one, right? So what is this rule of thumb? You mentioned the 1%, right? But what is this rule of thumb that you guide yourself by? And what exactly do you mean by like 1%?
Yeah,
For
so the
anyone
one
who may not
percent
know.
rule basically is like the total rents are the total rents you'll make in the month is really 1% of the purchase price itself. Very, very high level, because it's making the assumption that uh, the any debt service is being paid and all operational expenses, and you're able to get a decent return on it there. So it's just kind of a quick, like, hey, does it at least meet this parameter? And I know for some people do 2, some people do 1.5. All depends on what they're seeing at that point. So, but we typically try to like stick to around that range, and make sure we'll align that properly there. But that's what the 1% is, that the total month rents for the property is at or less than or at least 1% of the total purchase price.
Cool. So what does this indicate? Like let's say that we got an apartment building with, I don't know, 50 units, and the rents of all of the units are equal to 1% of the purchasing price, right?
Mm.
What does that mean? Does that mean it's profitable, or like, because I get it, like I get the concept, right? But
Mm.
what does that mean to you, like from your eyes and your point of view as a financial strategist and tax strategist?
Yeah, it basically means for me that at that point, we're most likely going to be able to cover all of the property expenses. Like, there's an assumption at that point, all expenses are covered, and you're not just walking away break even. Like, the actual returns, like that, it's too high level to actually determine what your returns are going to be.
Yeah.
But it's really just saying, like, you there's enough cushion within the rents coming in to cover the property expenses, and make sure people, if returns are being paid out, that there's at least a decent return being paid out there. So that's basically what it indicates to me, that there's some juice that could be
Got
made.
it. So man, so why would some people make it to 1.5, right? Or maybe even bring it down to 0.5 or something?
It's all just risk, how much cushion people want to see at their standpoint, their risk tolerance.
Got
uh,
it.
at that point. So like I said, and so especially like when interest rates are going up, um, materials, labor, all that's going up. So people may try to, like, hey, we need a little bit more, need to be at the 2% range. Now, I know a few years ago people were kind of pushing down even below 1%, because they were trying to just get more deals in. Cost of money was a lot cheaper, so you're not really going to
Yeah.
catch. It's even rare to even use the 1% rule. It's just like, that's kind of the starting point, and then you try to, like, kind of get a gauge on, based on how all the other purchase price and market rates on the rents are coming along as well. So take it all into
Got
account.
So yeah. So it's super interesting. So then you have your operating income, right? Like all of the income that comes in from all of the rents, and then minus expenses, that's like your net operated income, right? So is that something else that you look at, or what would be the second step after like a property hits that 1% rule of thumb? What is the next rule of thumb that you look at?
Well, it's not so much as the rule of thumb is what type of returns are we trying to make on this.
Oh, okay.
Is for us, but also for our investors. So like if we already kind of got through the high level aspect of it, let's kind of drill in further. Let's see what the cost associated with operating this property is going to be, what our cost of debt is going to be, and that's when you're kind of leveraging your network and your team on pulling that stuff, so you're not just kind of guessing at that point. So you're trying to drill down, get more solid numbers, because you want to be comfortable that you're presenting this to your investors and your lenders, because at some point, like they're not really going to care about rule of thumbs, like how is this really operating.
Yeah. Okay. So could you give me an example, like in a deal that you've maybe worked on, like the entire process from looking at a bunch of deals, maybe a bunch of them were under 1%, and then others were, like 2, 1, 1, 1, and then you decided to, go dive deep into one of them. Could you give me like tell a story or an example as to like how it looked like when you did decide to drill a little bit deeper into one deal that did make that first filter?
Um, there's so many that kind of hit that first filter, and then you drill down further. But I mean, for the ones that have worked out, it always like, hey, here's what our purchase price is. Even and there's times where like it's actually less than where we are with our rule of thumb, but is there enough space to renegotiate with the seller, and just kind of just go back and forth and just trade on terms from that standpoint there. So we've done that for properties in Georgia, properties in Virginia, just kind of going back and forth with that, where it's okay, it's not exactly where we are, and then when we drill down deeper, and it's like, okay, it's actually a lot more renovations that are needed and there's always kind of the case where you do a lot of value add property, especially one we done in Newport News, Virginia, and it was at I forgot the actual percentage, but it went from being like 60,000 a door and end up trading it down to like $33,000 a door for a 16 unit over here. But that was because the amount of work that was needed, getting tenants back in current, to actually make sense of those numbers. Now, I mean, things change once you actually go into contract, and things like COVID and stuff comes into place that you didn't account for, but you try to at least try to factor in uh, some contingencies in there as well, and some space so you're not so tight on your budget. So that's probably one example there, where it's like if we started off one way, we had to negotiate with the seller and get the price down to where it makes sense, because we knew how much work was going to be needed on the property once we started doing our real true due diligence.
Cool. Um, Awesome, man. So let's talk about taxes, man. Right? So
Mm-hmm.
like, I don't even know what to ask, right? I mean, and I guess I should have prepared. It's like with some key questions that I could come here and ask you so that you could, be the star of the show. But you help real estate investors with tax strategies, right? So,
Mm-hmm.
what are some of the common loopholes that there are in the like tax code? And whenever you talk to real estate investors, they just don't know about it. They're not even aware, and they're not taking advantage of.
A lot of, I mean, surprisingly, people don't realize, like when you're doing HELOCs on your homes, a lot of people are just trying to find additional funding to to get into more deals. The capital that you're pulling from your home, or as a loan, or a line of credit, like that's not taxable income. Now you're reducing the equity in your home, and you have interest and stuff you have to pay for. which could be deductible if you're using it for business purposes. So it's just being mindful, like and that kind of helps GPs or capital raisers just when you're talking to potential limited partners, and like just understand where their sources of income coming from. Like there's opportunity there as well. I see a lot of people still trying to set up their buying whole entities as corporations, and that doesn't really help from a tax perspective, as it creates more headaches. So just a proper entity structure goes a long way, whether you're doing wholesale deals or you're an agent or you're flipping or you're doing syndications or funds. It's all kind of like the proper entity structure goes a long way to ensure that you're not overpaying on this tax compliance aspect of things as well, and you're properly legally protected when you're working with your attorney also. So those are some of the things that we try to like educate people on. I know a lot of people have been trying to take advantage of the 100% bonus depreciation that was passed with the 2017 tax changes, and now we're starting to phase down every year or so until there's no longer. So we're in 80% for 2023, but there's still opportunities to maximize that. Or as I tell people, like there's actually a lot of deductions when you're doing these heavy renovations, and you can write off the cost of stuff that's being torn out of the apartment or whatever property that you're working out of. It's just maximizing cost segregation studies and getting detailed analysis of what was done, and not just accepting lump sum invoices from your contractor. So like the more detail you can get, the more opportunity to get more deductions. Is another thing that we work with people on as well.
So, man, for syndicators, right? Like people who invest in big multifamily deals, this is like the main type of person that listens to this podcast. Whenever you say, or like anyone says, oh, like investing in real estate is really good for saving taxes, right? What does that mean?
Well, it's the aspect of investing in buying whole real estate, whether in a syndication or just rental property in general, is tax advantageous. First and foremost, it's not subject to the additional self-employment tax or FICA taxes like people's W-2 or their business income is subject to there. So you have that benefit, and then you also have the benefit of depreciation to reduce that income even further, which is just is an IRS incentivizing developers and people to continue to buy and provide rental properties to the masses. But it also just creates this paper loss that you can continue to write off over a certain period of time as well. So that aspect of it doesn't really is part of why it can be tax saving, because like the income that you're making from the property is taxed at a lesser rate than your W-2 and business income, or not being taxed at all because it's completely wiped out with all the deductions that you're claiming. Then there's opportunities where if you have losses from your rental properties, depending on where your income level is and what your profession is, you could possibly use those losses to offset your other income. Now there's limitations whether or not you're a real estate professional and whether or not you're materially participating with the property. It's stuff that kind of there's check boxes that need to be addressed, but you can start to align yourself to whether you or if someone has a spouse to kind of get involved and take advantage of these additional deductions.
So, man, for depreciation specifically, right? So real estate has a tendency to go up in value. However, in paper, it depreciates, right?
Yeah, it's similar to a vehicle, and the IRS is basically saying like when you're owning the property, is going the even though it's appreciating, it's at the same time stuff is breaking down. The property is depreciating value from the actual physical, tangible standpoint of it, because it's
Yeah.
not going to be there forever. And they put certain years depending on the type of property. Depending on the type of building it is, what's in the building. So it could be 5-year property, 15-year property, 27.5-year property, so forth and so forth. So there's a lot of guidelines associated with it there. So yes, the value is appreciating, but the IRS, like I said, as part of their way of incentivizing investors to revitalize their property, sell them, buy more, to get more deductions and to help offset their rental income from there.
So for the depreciation side, how do you get to like a total sum? How do you figure out how much a property depreciates every single year? Like, what are the factors that influence that result, that outcome? Hello, morning kings and queens. At my company, Millionaire Network Automation, we believe in the power of networking. We believe that in real estate, your net worth is your network. This is why we help real estate investors raise capital by connecting them with their ideal investors and helping them build a massive network of their ideal investors in less than 30 days and with only 4 hours of work per week. If you're interested in this, click the link below in the description of this podcast to learn how you can propel your growth with a reliable system that will consistently help you connect with your ideal investors, build trust, add value, get your investors to promote you and put you in front of more of their investor friends, and raise more capital faster and in a much more effortless way so that you can achieve your financial freedom and still have the time and the energy to pour into every single other area of your life. So go watch the training, and you're going to have the opportunity to book a call to talk about how you can get this 100% done for you system implemented in the next 5 days. So thank you for watching, and I'll see you later, and enjoy the rest of this episode. Bye-bye.
Yep. So you have obviously the purchase price of the property. What's the intended use? If it's a commercial space, if it's a short-term rental, if it's just a traditional residential property plays a factor into it as well. The land value that either is assessed by the city or assessed by the appraiser, because you can't depreciate land. So that part of that percentage of the purchase price has to be backed out, as well, to take that to take that into consideration also. And then what's in the building itself? Like, is there a fence? Is there a pool? Light fixtures? All these different things that will help determine what the building basis is and what the different components as part of the property is assessed as well. So a few different things that have to be taken into account.
All right, and then you come up with like a sum, a total sum of like depreciation. Is that per year, per month, per quarter, per
So
30 years?
Yeah, your depreciation. So let's say you bought a property for $500,000, and let's just say that $100,000 is considered land value. That $400,000 is now what's considered your depreciable basis for the building itself. Now, if this is just a traditional, let's just say a 10-unit apartment building, long-term tenants, that's going to depreciate over 27.5 years per IRS guidance there. And then so that 400,000 is going to slowly depreciate year from year. Even if you refinance, even if the tax assessed value of it or the market value of it goes up, it doesn't matter. It's still based off that 400,000. That's not going to change based off the market itself. Now you can do things to get a larger deduction than that example with, like I said, cost segregation studies and breaking things into different components. But but like I said, for that example, you're going to start off with that $400,000 cost basis.
That's crazy, right? So you do the segregation study, right? You figure out that over the span of 27 years, it's going to depreciate, I don't know, $300,000, for example, that $400,000 property that we're talking about. And let's just say, right, that it's $300,000 in depreciation. Could you bring that to the first year, or do you have to wait 27 years for you to get that depreciated?
You're going to be recouping it along the way, because things like you got the value of the roof, you got the value of the walls. If you have hardwood flooring, siding, stuff like that, like all of there's certain things that have to be depreciated over 27.5 years, no matter what. The cost segregation study, which is an engineering report, like that helps breaks up, because not everything within that building is all 27.5 years. There may be a driveway. There's light fixtures.
Cabinets.
What do you say?
Cabinets, the things
cabinets,
inside the units.
Cabinets, appliances. Like the purchase price includes everything that's involved with that property. But if you're just taking that purchase price, backing out land, you're gonna have to depreciate over 27.5 years. But if you invest into to these study reports that actually will help break it out further, or it's going to identify what's your 5-year property, what's your 15-year property. So those obviously depreciate at a faster rate then your 27 and a half years, and then with the 2017 tax changes, you're able to front load anything that depreciates less than 20 years into the first year.
That's crazy, man.
So it was 100% between 2017 and 2022 was 80%. So let's just say out of that $400,000 building basis, let's just, for the sake of the conversation, let's say $50,000 of it was 5 and 15-year property. In 2022, that whole $50,000 was considered bonus depreciation, all recognized in 2022. If you acquired the property in 2023, only 80% of that would have been able to be front loaded into 2023 expenses, and then the rest is depreciated over their respective 5 or 15 years. But the 27 and a half years stays the same from that angle.
Okay, so let's say that you figured out it was 50,000, right? So that means that 50,000 is deducted from your tax bill at the end of the year, or how does that work?
Well, the depreciation is just an additional. It's a paper loss, the paper deduction expense. So it's going to reduce your taxable income if you're recognizing that whole 50,000.
Got it.
Could it reduce it down to zero? Yes. Can it reduce it down to a negative number? Yes. If it's a negative, can you use it? All depends upon your facts and circumstances of if you're a real estate professional, if you are, like I said, if you are material participating with the property itself. So you may or may not be able to use that loss if it is to that benefit. But that's where the additional assessment of the individual comes into place.
Oh, okay. And then, I mean, I don't know, like I don't know anything about this, man, but I'm just using my logic and my common sense, to figure out that if you bring, like your income all the way to zero so that you don't get taxed, then you're a real estate investor looking to go to the bank and ask for a $500,000 loan. Well, then they're gonna look at your financials and be like, well, you have no profit, right? How are you gonna pay us? So in my opinion, taking it to zero or even a negative wouldn't be such a good idea, like you said, depending on your circumstances, right? Like if you're a real estate investor looking to go to the bank to leverage their capital, take out a $500,000 loan, and then they see that you have no profit, then they probably won't accept you, right?
Well,
So
that's where the loan and the tax returns separate at that, because depreciation is not a cash expense. You did not spend $50,000 on your and to
yeah,
get these deductions. Like you probably spent, depending on the cost set company, a couple of $1,000s to get it. So banks should only be assessing the tax return based off of operational expenses. So if you have non-operational expenses like depreciation or mileage, like stuff like that, has to be backed out. And I say that stuff we work with our client lenders on, because not every lender understands that from that standpoint. And but there's a lot that do, and there's like they do know, like anytime you're depreciating, like okay, that needs to back up. So that $50,000 from the lending side actually goes away to show your true net operating income from running the property.
All righty, man. So apart from what we've talked about, right? Like real estate has a different tax structure than let's say if you're a W-2 or a 1099 or whatever, right? So that's like it's taxed different, and maybe it's not even taxed at all. You could use depreciation to your advantage. So there's so properties go up in value, appreciate, and at the same time go down in value, right? Depreciate because everything is breaking down. And you could use that. You could do the study. I don't remember what the name of that was. But segregation studies. Is that what it's called? Yeah, to come up with like a solid number. Deductions, losses. I want to talk about the losses, man. Like, I don't understand that one. So could you explain to me what it means to use losses and be able to use that against your taxable income, and offset that?
Yeah, so a lot of people are still a lot of investors are still using their W-2 income in order to invest in real estate until they reach their financial freedom number, and then they can not work as many hours or leave their job. But in order to use the losses because there's three buckets in the IRS. There's three buckets of type of activity. There's active activity, which is W-2 income, businesses that you're actively operating. There's portfolio income, so capital gains from your stocks and bonds, long-term investments, and there's also passive activity, which is your rental real estate. It kind of falls into, or any business that you're earning money from, that you're just a debt or equity partner associated with that business. So those three buckets typically do not mix. So man, people see all the time, like with their stocks, if you have a $20,000 loss in your stocks, unless you're a professional stock trader, you can only recognize $3,000 of those losses, and the rest is carried forward from there. So there's limitations that the IRS has put to prevent people from just passively just throwing money into real estate, get losses, but not really are involved with the operations of it, and using that against their W-2. A lot of high net worth individuals kind of stumble across that quite a bit, and they just have all these losses built up that they can't use. So in order to be able to use those, or really to activate those losses, there's certain things that you have to prove. One, being a real estate professional and material participating with your properties, or if you're investing into short-term rentals, there's a loophole that allows people to leverage the losses off of that, or the sale of the property that you may have some built up losses from, that actually activates those losses to, one, offset the capital gains, and potentially use the losses to offset your other income buckets as well, because you now have gotten rid of the asset itself.
Mm. So then if you come up with like a specific number of losses, right, and then you have income, taxable income, let's say that you are a high net worth individual, a doctor making $1 million per year, and your taxable income is, I don't know, does offset mean that you could use that amount of losses to deduct from the final
Oh,
taxable income?
so for your example, doctor making $1 million a year would not be able, is like, say, if he just passively invests into, or if he just has a rental property in general that's generating taxable losses because he has a high volume of depreciation come in, he's not going to be able to use those losses to offset his doctor income,
Because he's passive?
yeah, one, that he's passive. Two, he's not a real estate professional because he spends most of his time as a doctor, like not actually running a real estate trade or business at that point. Now, if this doctor is married, then his spouse, depending on if his spouse works or not, the spouse can possibly qualify as a real estate professional and material participation as well. So that, because on the tax return itself, it's not each person has to qualify; it's just one of them has to qualify.
Yeah, that's crazy.
So that's where you have that people bringing on their spouses to get involved, because it actually allows them to use their rental losses to offset their high incomes.
So man, yeah, it's really awesome. So we have a couple of minutes. I do like to end every episode with a couple of questions that I want to ask. And however, what is like the favorite thing that you like to say to multifamily real estate investors, right? Because a lot of them, I can see how a lot of them are not educated on finances and taxes and all of that. They're just like looking down to take looking up to take deals down, and operate them and sell them, and the net operating income and renovating them and all of that kind of stuff, but not so much on the back end, right? Which is all the finance and tax stuff. So, what is like your favorite thing to make multifamily real estate investors aware of, right? That just gets them to be like, oh, really? You can do that? You see what I mean?
Yeah, it's really more so, and it's case by case, because it's based on like what that individual is doing. So it's never just one particular thing. It's more so because when people try to get the tax savings, always tell them, like, and I haven't, Kim, it's not my phrase. It's just a saying that don't let the tax tail wag the investment dog. Like, if it's a good investment, invest in the deal. And then strategize ways to leverage the tax code to help offset the income, because what's really creating their tax burden is very rarely is the investment, is more so is where their source of income is coming from. Now, if their source of income is coming from other real estate, there's a lot of opportunities there to offset all that. But if it's coming from non-real estate or W-2 type of income, then okay, now we're really trying to strategize how do we offset that. From there, like what type of investments. And I say it may not be multifamily because you're not going to be able to use those losses. So if you're trying to accelerate and use some losses sooner, then now we're looking at, hey, do you invest in different types of assets that allow you to take the losses, or do you basically use the income from your real estate that's being taxed at a lesser rate or not being taxed at all to help alleviate your tax burden from paying the tax bill from that perspective there, or start to strategize, okay, how do you leverage the family, especially if the person is married, and see if the spouse wants to be involved as well. So like I say, if I had to kind of wrap it up into a saying, it's like let's look at your situation as a whole, and then let's strategize from that standpoint. Because then I can start to kind of explain these other pieces to it where it actually can help click for people there, instead of just looking at one investment individually, not knowing that your whole tax ecosystem is going to affect whether or not you can benefit from the losses from this property.
Yeah, that's awesome. So for anyone who may want an opportunity, to maybe learn more about what they can do, the strategies that they can apply, the tactics they can execute when it comes to saving more on taxes and any other loopholes they can implement, and they may want to talk with you or just get a hold of you, maybe ask you a question, just connect. Where would be the best place to do that, man?
I'm on social media. I'm on Instagram, I'm on Facebook, I'm on LinkedIn. Larry Pendleton CPA. Rather easy to find up there. Then from there you can see the link. I imagine it'll be in the show notes. Just kind of the link to my personal page, where people can kind of see other podcasts I've been on, different deals that I've worked on, and then schedule a free intro meeting, or they want to jump into getting a consultation session. Those options are up there as well.
Nice, man. um so, man, what is the biggest expenses, the biggest expense of a person in their life?
Tax is going to be their biggest expense, because people look at the income tax, but you have sales tax and everything, payroll taxes, and all that kind of playing the factor. So that's going to be, I mean, your biggest expense, besides any like debt that you may be taking on as well.
Yeah. Yeah, so taxes are the biggest expense in someone's life, right? It may not feel like it, but add it up and you'll see, right?
Yep.
Um, income tax, like sales tax, payroll tax, home insurance, whatever. I don't know, man. I don't even know. But yeah, so it's really important, right, to get our hands on this kind of education, on educating ourselves on how we can not cheat the system, but use the system to our advantage to save on tax, maybe make money on tax, and just implement all of these strategies that are out there and that are there to benefit people like you and me and business owners and developers and real estate investors, right? To encourage them. Are there any books that you would recommend? The everyday entrepreneur who's into personal growth and personal development, and like reading a book or listening to one is part of the things that they do just to expand their awareness. Are there any books that you could recommend that would really make you aware of the possibilities in this topic, man, in the taxing and finances and all of that?
Yeah, I would tell them to look up Tom Wheelwright, and Amanda Hahn. They got they each have multiple books regarding taxes. Amanda's more so on the real estate side. Tom Wheelwright's more so kind of overarching across the tax code itself. Mark Kohler as well. Like all of them have multiple books. Like those three authors are really good CPAs in this country. Probably the top one, like probably three of the top in the country. But like they put out really good content in the form of books and podcasts that people should check out, and then work with their tax advisor to see if they're leveraging those opportunities.
Cool. So, man, another question that I have for you is, what is a networking strategy that works for you?
For me, it's really more so of going to where my clients are going to be. I mean, as CPAs, we got to do our continue our CPE training annually and get educated, and that's fine. But for me, it's just really kind of going to where my clients be, where people that I want to network with. Like if I want to get into note investing, go to note conferences and all that stuff as well. But then once I get there, identify how I can be of value to whoever I'm talking to. So that does require a lot of listening, just absorbing what that person is saying as I see if there is a pain point. So they may not need the tax help. They just may need capital. They may just need a strong team in place. So like, but that's typically my go-to is go where my clients are and then just listen, ask questions, and identify where people are where we're in need of where I can be of value at.
Cool. That makes sense. Totally. Marketing 101, right? Go where the people are. Go where your ideal clients are. So, man, let's see. The next question is, do you have any deals going on, or is there any resource that you may be looking for right now?
Yeah, so we're getting heavy into the note space. Or our investing strategy now is notes and also new development. So we are in the midst of raising capital for some new constructions that we're going into, as well as some mortgage notes that we're looking to acquire as well. So we're always happy to kind of talk with whoever wants to potential partner as a debt partner or equity partner on these deals that we're working on.
Got it. All right, man. So, and I ask because the people that listen to this podcast are, some of them are active real estate investors, some of them are passive, right?
Hmm.
So it's always good to put that out.
Yep.
The next question, man, is if you could go back in time and do something different in your real estate investing journey or your financing career, finances, taxing career, um, to maybe speed it up or I don't know, make it be more easier, faster, I don't know, less friction, right? Is there anything, any like piece of advice that you would give to yourself to be able to accomplish that?
Uh, put the ego inside and build the team. That'll be the one piece. Like you don't have to do
That's
it all
huge, man.
yourself. Like I said, and you don't have to be greedy. Everyone can and just find the right deal that everyone can eat off the table from as well. So that'll be the one thing there is like because create a lot a lot of friction, a lot of family problems, some financial issues as well of trying to do everything yourself and just drive yourself crazy. Whereas like that, uh, taking the Dan Sullivan approach and finding the right who's in order to accomplish what I'm looking to accomplish.
Yeah, nice. So, man, when you say put the ego aside, obviously, right? Because maybe I don't know, maybe you believe that you had to do it all, or you believe you could do it all. What was like the internal dialogue you had? Like, what were the exact thoughts and feelings that you went through while facing this, this decision, this event, I don't know how to call it, of I need help with this, but no, I'm gonna do it. Like, what were the internal dialogue, the thoughts and the feelings that you were going through that didn't allow you to get out of your way and build a team around you?
I think just you grow from your mistakes. I mean, every like my first deal was actually a really big success, and trying to roll that into something else, but it's like you still haven't. So it's like I needed to be kind of checked uh, by uh, uh, by life itself to have that recognition of like, hey, like no one's running these whole things by themselves. Like no one's putting up all the money themselves. No one's doing all the work themselves. You get what you pay for. So find like having that dialogue is like you find the right people and you bring value to them and they bring value to you as well. Like saying it's going to cost something. It's like I much rather pay for a higher quality service than to kind of skimp at like handyman as contractors or try and do stuff myself. It's like that's not what I'm passionate about. I want to focus on what I'm passionate about, what I'm good at doing, so that and let other people be great at what they're doing, so they can shine as well, and we all can win at the end.
Great insight, brother. So, man, is there any last message, last piece of advice or words that you may want to share before we end this?
On the tax financial side is really leveraging technology or leveraging bookkeepers to make sure that your books are in order. Like I said, we can talk about tax strategies all day, but if the books are in order, it's going to make it hard to take advantage of it. It's going to take you a very long time to kind of organize it. And I think people have lost the insight. Like there's value to having someone to do that for you, because if you're not into doing it yourself, you're going to keep putting it off, and you're going to keep not tracking your receipts and all that stuff. So it's like, go ahead and like invest, like, I mean, so many different accounting software that help people with that type of stuff to make it streamlined. And there's a lot of great bookkeepers that's willing to help people along the way. So it's just finding, like, get your financial house in order that way, organized, so that it'll make the process a lot smoother when it comes to tax strategies and tax filings and all that there. So, and then, like I said, when it comes to the investing, is always going to be like just bring value to people you want to partner with, and that's going to go a long way.
Cool. So you can't get to the taxing strategies without first keeping track of your books, right? And keeping them in order. So what does that mean? What does it look like, for any investor or entrepreneur out there running a business? What does it look like to maintain well-ordered books?
Yeah, so it's like having like your income statement and your balance sheet all set, and like if someone's able to, like, hey, there's what's this $50,000 deduction on your books, and if you can't really explain it, and then he's like, oh, I spent this, it's like, well, we got, like, where's the support for it? Because if someone ever comes back and you're audited for it, you have to, like, the burden of proof is on you to prove it. So it's like, let's get everything cleaned up on the front end so that there's less questions and less people having to perceive red flags on your financials on the back end. So that's the huge play there, of making sure that stuff is in order. So we see it happening now where people cannot show the IRS that they have these evidence for certain things.
All right. Well, Larry, it's been a pleasure, man. It's been a pleasure connecting you and learning from you here. Thank you, man. I enjoyed it. All right.
Thank you. Yeah, if there's anything else I can do, let me know. Happy to support where I can.
Awesome, brother. I'll see you later. Thank you for listening to the Modern Real Estate Investor Podcast. We want you to know that we love and appreciate you, and we are super grateful about being part of your journey of becoming a successful real estate entrepreneur and having it all. Please share this episode with a friend who you think will be impacted positively. Send it to someone who you know is interested in real estate and dreams of having it all and being the best they can be across all areas. And if you thought this episode was really valuable, share it on your social media as a post or a story. We have a special gift for all of those who contribute to the Modern Kings and Queens movement. So for those of you who decided to share this episode and help us spread our message, send me a message letting me know on any social media platform at Alex Ramirez, the Modern King. I have a special surprise for you. Thank you for watching, and I'll see you later.